So we're moving forward with efficient markets and behavioral finance, and this topic basically we're going over the idea that prices are in fact efficient, and we have a random walk theory, and we have the efficient market theory that we're going to go over some limitations of the efficient market, and we're going to go over behavioral finance. This is a whole relatively new field of an update to what has been previously thought of as what ultimately sets market prices. So going over efficient markets. So this is the idea that all the information is already out there, and people and buyers and sellers are rational actors, and based on all the information being out there, they do their research and they understand the probabilities of all outcomes and the related financial implications of all probabilities, and then based on this they make their buying decision. This is obviously mainly related to NPV, net present value, and essentially as it relates to buying stocks or selling stocks, and basically saying that folks will make the right decisions because they'll be compensated for it, and they won't make bad decisions because they're gonna lose money. So it's basically saying that people are rational, actors are rational, and based on rational actions, prices will be fair. And how will prices come about to being fair? Because they will be either bid up or bid down based on the NPV. What's the net present value of this outcome versus that? And people will bid up prices as long as it's a good deal, or they'll bid down prices if it's not a good deal, and the price will be efficient, right? So this has been the efficient market theory. It's also called the utility theory in economics. And some of the limitations have been that when we talk about behavioral finance, there's also a view that says, hey, this is not necessarily all there is. We can also look and see people may not know all the probabilities. People may misprice probabilities consistently. People may want to have shorter term payoffs than longer term payoffs. People may be too scared of an improbable probability and overestimate it in their assumption of how much they need something. And so behavioral finance essentially says that it's not 100% rational, like we're computers that understand all these little nuances of probabilities and NPVs for every outcome. Rather, we certainly prefer winning over losing. We don't, we really dislike losses, even if they're small losses. And we don't necessarily value long-term outcomes compared to shorter-term outcomes. And we may well misprice certain catastrophic risk by overestimating it, like an accident or something like that. Or in terms of insurance, people may get insurance that they may never use because we're overestimating the risk. So this chapter really goes over these kind of things and talking about the same thing of figuring out NPV, but also understanding the background theory of what brings NPV into life in terms of on a large scale, in terms of a market. And we also have random walk theory here, which talks about a little bit how stock prices, the next performance outcome can be quite a random thing, and how does that play in terms of predicting values. So random walk basically says that we could have random outcomes, but over a series of time, knowing the variability, knowing the volatility of the randomness or its direction can help in estimating prices as well.